Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, March 16th, 2020. I want to do a follow-up. I already posted an update and went over QQQ and SPY, gave you my thoughts there, closed out the QQQ short trade. If you missed that video or that post, basically, look, I'm very, very much open to the possibility of more downside, but I do the math, I do probability statistics, what's likely, and although I can certainly make a case that we could, drop another 10, 15% from here, possibly even more, especially if some big bank or brokerage fund or brokerage firm or hedge fund blows up, and that's certainly a real possibility. Or the macro picture continues to deteriorate. The fundamentals in the economy. Those are all the things that can happen. On the flip side, we are very oversold. The market has wiped out the last 3 years of gains, over 3 years of gains, put us, the S&P 500 back to where it was back in early 2017, and so, stocks are certainly a whole lot cheaper. They've certainly priced in. You can say what you want where they're going, where they may go. I think ultimately they're going quite a bit lower. It's just more a matter of near term, this week, what happens. And so, with the 30% drop in the market in just a few weeks, that is certainly priced in, or at least that much of the impact of the coronavirus. You can say that a 30%, let's just say a 30% drop in earnings, 30% reduction in market cap valuations of these companies out there. And again, the big question is, we'll just have to assess the technical and fundamental landscape as it develops to see longer term where we go. Let's just look at levels this week that could come into play in the market. I'm starting out here with the NQ Nasdaq 100 futures chart. Here's that 77,000 level again, where we hit on Friday. We hit it again today. That was let's see. Let me zoom in for you real tight here. Grab this. Hold on one sec. Okay, so there's Friday's candle. And here's today's candle. So we, about equal lows so far. So that's what you're looking at is we closed down towards the bottom, where on Friday we closed up towards the top there. We hit it and bounced, and today we closed near the bottom of that range, but we're still above that support for now. It's holding. And so you have these three big candles here. And, this market can go either way. Like I said, I closed out the QQQ short trade on the site officially to reduce our net exposure to the market. And, in a sense, if everything continues to melt down and go down, then our LQD short trade should go down. But I also think the upside will be a lot less limited on that LQD short trade than it would be on QQQ. If we get the opposite, if something big happens this week, the government comes in with some more, heavy ammunition to try to prop this market up, whether it's a ban on short selling, whether it's some other creative, financial strategy they come up with, the Fed does, that, to prop the markets up. And at the end of the day, it's valuations, like I said. So we're going back to prices where they were, where the S&P was trading back in early 2017. Here's SPY, and there it is. So that's where we closed the day. Here's where we were trading, right around that same level back in the beginning of 2017 there. So how much of it's priced in? And again, doesn't matter long term, probably going lower, and we could go lower in the near term, but I'm going to show you levels I'm watching. So what we're going to do in this video, since I already covered SPY and QQQ extensively, showing you, this support zone was hit here today, I'm going to cover the 11 sectors in the S&P 500. We'll start out here with the weekly charts. As I go through these, keep in mind I'm going to go through the 11 sectors of the S&P 500 in order of weighting in the S&P 500. I haven't updated these figures. Every now and then, every few months, I go in and change this. It's been a couple months, so these numbers are going to change somewhat from where I had it here. But this last I checked, it was a 23.2% weighting, XLK, that is, the technology sector. So by far the largest component of the S&P 500, and even double that in the Nasdaq 100. Nasdaq 100 is roughly half technology stocks. So, but we said this. If you can only chart one sector and you want to know where the market's going, you you'd be fine just using XLK, because wherever it goes, that's where the stock market goes because of that heavy weighting. It's simple math. There's no way around it. Those companies are the largest, the only trillion-dollar companies out there in the U.S. market are Apple and Microsoft. I'm showing, if my chart program's right, that Apple's still, about 1.2 trillion, Microsoft's 1.1, and then you have, of course, a lot of the other big companies, multi-billion-dollar companies in there. Okay, so what am I looking at here? Daily chart, I have support here around 70.19, a pretty decent support level too. If that goes, it doesn't look good. There's really not a lot. There are some other support levels that could come into play down here, but we are coming up on support. We are deeply oversold. And on this weekly chart, I have a trend line here off the 2009 lows, March of 09. And that trend line comes in. You had this was a mini crash right here, but we closed back above it, so there's a reaction. There's more reactions here, 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 and now we've fallen to that. So we don't have a reaction yet. We closed on it, but let's see if we hold, bounce tomorrow. That'll give us another reaction to help validate that. Otherwise, like all trend lines, they eventually go, and if that one goes, it's just going to be another check mark for the bearish case. But bottom line is we do have the tech sector at support here on the weekly and very near support there on the daily chart. Not too far off today's lows, that major reaction low from back there. Alright, so there's one that is getting stretched, and at support we could bounce. The second largest sector in the S&P 500 is XLV, the healthcare sector. What do I see here? Forget about all these other lines. We'll turn them off for a second. I see a decent support right around these current levels. This, as you can see, in recent years, we had some resistance here. That's contained the pullbacks. It's a support zone. That's why I use two lines. That's why I use this box tool. It's contained either the top or the bottom has contained all pullbacks going back to 2017 here. And we're also back to that period in mid-2017 there in healthcare. And this is normally a defensive sector, but again, this is a combination of fundamentals that are really working against the market right now in a lot of these sectors. For an example, my wife works for an international pharmaceutical company, and before they even did it, they just pulled all their all their reps out of the field. And imagine what the cost is to have your pay your reps to sales force to stay at home. I think, she has a couple hundred reps under her just here in Florida. To put all those people at home, and actually their company was not the first to do this. Most other companies had already done that, pulled their reps out of the field, and it didn't matter. It was moot because the doctor's office didn't want to see them anyways. They were blacklisted at most doctor's offices because the doctor's offices, they don't want reps going from office to office, coming in, sitting in the waiting area with all the other, sick patients that are there to see the doctor, some of those which may be, contagious with COVID-19. So the doctor's office is like, no, we're not going to see reps. So my point is, trickle that down. That's just one industry. Think of all the other industries that have sales reps out in the field. And so that's going on. So therefore, the healthcare sector, which is normally a defensive sector, is feeling the pain. Now, there's many different companies within XLV. They're not all pharmaceutical companies, and some may do good. So what happens? The baby gets thrown out with the bathwater. We'll have to find the baby soon, and there may be a tradable bounce coming up here. There will be sooner or later, I'll tell you that. But how long we stay to that party, if I even make it an official trade, it's yet to be seen. But like I said, I feel good closing out the QQQ short trade, and I think there's a decent chance we could bounce off these levels. That's why I'm doing this video. So there's XLV, divergent high right there. You could see the negative divergence on this daily chart that played out. And then here again on the weekly chart, negative divergence. And so what I look at here, we have a trend line right here, this blue line. I need to pull that down here. That's the bull market trend line right there, the blue one. And it comes in, a couple reactions here, and that was recently broken. So you have a long-term sell signal. It would indicate that XLV is going lower over time. However, you're coming up on that pretty decent support right there around 80.64. See that previous reaction low that was that major low back in December of 18 right there. This is a weekly chart again. A lot of reactions there. So if that goes, I can tell you the next support, it's not too far below at about 76. So we're really getting close to, and I would put this yeah, an even stronger support. And if we get there, we're going to be even more oversold on XLV. So there's one that looks to me to have before the odds are really good for a bounce, about 7% downside. So might be time to start stepping in here and nibbling. Now, where does this one go over time based on where I'm looking at this chart? What I'm looking at on the chart, probably down here at about 65, 62. If we get any of those big catalysts that I was talking about in the market, any mutual funds or hedge funds, I should say, blowing up, a brokerage firm, a bank, anything that can have some ripple effects in the financial system. I'm about to get to banks and financials here in a second. They don't look good at all, but they are at support. So that's it. That's how this thing works. We'll get oversold. Support levels in a bear market, they're either going to act as support to have the buyer step in, or you go right through it. Like in this case, we went right through that 86.71 support last week on this weekly candle, and so far we're down here. We touched that next support, and we either bounce from here or we continue lower with the market. And again, I think the odds are rapidly increasing for a pretty sharp, more sustainable counter trend bounce that can last for more than just a few hours. We had that big sharp rally on Friday, but that was a one-day wonder. That was an intraday reversal, and it was faded. And you can't even see it here on this, this weekly chart. It doesn't even reflect. You have to go over to the daily chart and take a look, and you see it. And what a beautiful, re-entry on a short that would have been. You had a trend line right here. We bounced back to after falling to this support level before. But again, this is a pretty nice support zone. I don't want to spend much more time on that. Let's go to the next one, XLF. Financials. They're in not a bad spot. Let's turn all these lines off. Let's do it on the weekly chart. You can see it a little better here. Let's go here. All right, and let's do the same thing. Let's turn all my lines off and just look at this chart for a second. So what stands out here? We have let's get away from the bear market lows. The financials had virtually collapsed. They had to be bailed out by most of them by the federal government. The big banks did. But what I see since then, since we stabilized, it's the same thing on SPY. I've been targeting for a long time those late 2014, mostly throughout 2015 and into 2016 highs right there. And so that is a key technical level. And if you bring it on over here, we'll put the lines back up now. You'll see that we're sliced through that, and then we have the bottom of that 2015 trading range right there, most of it as the next support line. So right here, we'll box it in. See, we traded there for a while. Then it had that little mini crash in the market in a lot of sectors. We came back in that range. And right there it was resistance, we took it out. So there was a lot of reactions on that lower line as well, and that's where we fall into. Now, financials look like death. They're in free fall. All these big divergences that we're building, they indicate a major top, and so far that's pretty much what it is. And this I'll tell you, this is scary. This is what I've been warning about. That a blow up in the financial sector, this rapid shift, never before seen in history, that I can call such the economy doing such a 180 from going on solid footing, low unemployment, everything chugging along, to all of a sudden, sectors and industries around the world and factories and cruise lines and professional sports leagues shutting down. We haven't seen that. Not even in wartime have we seen such a rapid shift in the fundamentals. And so what concerns me is there's a lot of moving parts to the financial markets, and one of those is when they don't price in risk. Governments sat here for years telling us, oh, the banks are in great shape. We've been running stress tests that look at worst case scenarios in the market, and the banks are fine. Well, why are the financials falling? One of the hardest sectors right now. Why are they down? In just a matter of a few weeks here, why have they dropped 40%? More than the stock market, much more than the Nasdaq 100, tech stocks, everything else. This is concerning to me, and so this is if the coronavirus was a black swan event that triggered all this, this could be the black swan event, for the financials break. That really, so something to watch. However, let's look at where if the selling's a little overdone. Like I said, they're at support. Man, if they break that support, I just don't. There's not a lot below. I mean, you're talking some levels down here, about 1340. If the financials go here without stopping, they drop another, down to that level. And I'm not saying they're gonna. It's just let's get out of Dodge time. That's just they. I don't think they can. I don't think the system can tolerate it. It would tell us that there's going to be a big failure, a failure, I should say, in some systemically important financial institutions. That's what I think that would be pricing in if the buyers don't step in and buy here. Smartest of smart money in the world. When I say smart money, I'm talking knowledge, insider information on Wall Street. These are the guys that are, in there. Goldman Sachs and J.P. Morgan. I don't know how Jamie Dimon's doing. I know he was in the hospital recently. Well, we'll see what happens. But when you look at those individual banks, J.P. Morgan, the largest bank out there, is look at this free fall, and that's not a good sign. It's not a good sign for the financial system. A 40% drop in a matter of just a few weeks here, but coming up on support. So here's the thing. Either JP Morgan's going to blow up or they're going to step in and buy it here, most likely right around that 82.20. It might not even get there. That's a pretty good support. If it takes that out, again, the lower these banks fall from here, the lower the stock market falls, the greater the risk. That's how it works. More and more you're going to have, if you don't have a fund or two blowing up yet, or a big bank or someone that had their hand too deep in the cookie jar, over leveraged, you're going to get it if the stock prices continue to fall, because that's where where things blow up from. When you have a leveraged portfolio, you're long stocks, and of course the majority of institutional traders were long here, as retail traders were at the highs. This only makes sense. And so a drop like that, can trigger those, forced margin call selling, that it's not a good thing. So there it is. So either way, I'm showing you J.P. Morgan extremely oversold. We're seeing levels not seen like the S&P 500 since the last bear market on the oversold readings. Even here on the weekly chart, you can look at the rest of them if you want. Just click through all the. If you use TC2000, for example, which I'm using here, free stock. I don't know if Free Stock Charts has the holdings list. When you click on an ETF, like I am on XLF, the financial ETF, it shows you. So these guys have all, I just want to be clear, they've all broken their bull market uptrend line support. So, and they're clear by the moves down already, they're in a bear market. There's no arguing that. Most of them had the same technical posture of the stock market, these multi-year divergences that people chose to dismiss, or maybe they're just not, aware of what that means. I mean, waning momentum. We had divergent highs here. These were corrections within the ongoing bull market here, but they were big, and they were all preceded by divergent highs. About 25% on that first one. This divergent high was followed by a 16% drop, and so far this one in Berkshire is followed by a 23% drop. So, however, what's different this time around? It broke a decade-long bull market uptrend line, and so this is most likely just the beginning of a bear market. But what I think is, probably the first impulsive wave down, we're probably looking at a kickback rally soon. That's what I favor. The government's going to come in and do what they have to here. If we drop another day, they'll come in, they'll ban short selling, they'll print more money. They'll do what it takes to at least temporarily halt the selling, most likely. And if not, then we're looking at Armageddon stuff. And I tend to think that's not going to happen right now. But that's it. I just want to tell you, a lot of these banks, they're either at or very near support. So, when I look at, J.P. Morgan and Bank of America, I can see very, very good support here, about 1829 on Bank of America. Look at that, going back for years. Again, I'm on a weekly chart, guys, so you can see this scaling down here. And so when I see this, usually the stock gets that close, it's usually going to make a run at it. So from where it closed today, it bounced a little off the lows. That would be about another 10%. So what that might indicate, we don't have to hit that if the whole market and the sector bounces. Maybe Bank of America just overshot this level. But what that would indicate is maybe one more bad day this week, another lock limit down, futures, the circuit breakers come on the market. Remember, Bank of America has to trade during the regular session. The S&P for the circuit breakers in the market to hit. So that'd be it, about a 10% downside. Anything, if that level goes, on a daily, solid weekly basis and it's not recovered, we're talking Armageddon. Get out of town. The banks are going to start failing and stuff, and I just don't think that's going to happen yet. So again, that's why I closed out the QQQ trade, and I think the risk reward right now is it's no longer favorable. You can bet, you can stay short, especially on index ETFs where you have no control what happens in the futures overnight. You're subject to a large gap above or for or against your position. So if you want to place an Armageddon bet that the system's going to break here and the markets are going to plunge another 20, 30, 40, 50%. So go ahead. I just don't think it's worth it. So, like I said, if I had to be, if I was only could trade ETFs and I had to tuck one away for the night, in fact, I did. I actually took some, closed some SQQQ in some IRA accounts and went to some TQQQ. Yeah, so just starter positions. If they start to go my way tomorrow, I can add to them, and if they go against me, I can add to them too. And that's my plan. Is I'll only scale down on a losing position if I intend to do so. So I see a little more downside in the equity markets as a well, it could be a lot more. Again, we'll have to manage that, but I think that the probabilities say a little more, if any, downside. Wouldn't surprise me to see the futures run around tonight, ramp up, and gap up tomorrow, and then start the next rally here in the market. So we'll see. If I had the highest degree of confidence, I would add that as an official long trade. Maybe tomorrow, depends what we see in the chart. Maybe later this week. Maybe we take another leg down, hit all these next downside targets. Again, I shouldn't go through all these. I just want to say that these longer term charts are clearly bearish, but when I put these support lines, yes, broken down long-term sell signals, but nothing goes down forever, and there's nice support right there on Citigroup. Also just a little bit below where we closed at 41, about 6% downside. So I see minimal downside in the financials and big snapback rally coming, or Armageddon, get out of Dodge. And again, I favor the at least this point in time, the central bank saving the day, and also retail investors, any institutions that have any cash left, you're going to see some buyers step in at these levels soon here. All right, let's get back to the sectors and we'll wrap this video up. So that's XLF. Again, weekly chart at support. I showed you, more importantly, some of the banks. That's why I kind of drilled down into the individual components. Things get ugly, like I said, maybe 13, 16, but man, that's really ugly. And fortunately, the good thing is the financial sector it's only about half the weighting of the tech sector. So while it might not have the same impact and won't have on the S&P 500, again, it's a very critical sector of the economy. We can go over, they're all important in their own way, but that's obviously one of the most important. That's a systemically important sector. That's why the government came in and bailed out the banks during 2008. XLC, communication sector. This used to be in the S&P 500. There were always, for years, have been 11 sectors, but there used to be the telecom sector. But telecom isn't what it used to be. Ma Bell, AT&T isn't really Ma Bell anymore. These are now so they changed it to XLC in the old telecom sector, and it's called now the communications sector. And when they did that, so they had to change they got rid of the old XTL, I think was the ETF, if I'm not mistaken, telecom ETF, and they added in XLC back here in the middle of 2018. So we don't have a lot of charting history is what I was getting at here to go, because it's a new sector and a new sector ETF. But traders are going to look at that. That's the biggest, the most salient technical point on this whole chart is that major reaction low from December 2018, and we're just a little below there. So this would also speak to that one jog down. Now the market doesn't like to give people what they want. We get that. I can tell you that's an objective level to step in if we get it, even if we overshoot it. And if you want to play it safe, if you overshoot it, wait for a recovery back above it. But not just XLC. Look at the XLF. Everything that I'm looking at here, all these stocks in the market, if you see these support levels hit or broken but then recovered, that could be your long. That would be the little bit higher probability entry. But what the stock market likes to do, it doesn't like to make it easy. And if all eyes are looking to go long at XLC right here, why not reverse there? Keep the shorts trapped in because they were trying to eke out the last few percentage points and deny the longs an objective entry. That's what the market likes to do at times like this. So when I see market coming up to support like this, I'd rather get long a little early than a little late. And there's that whole second mouse syndrome. Sometimes it's better to be the second mouse because the second mouse gets the cheese. But I don't know. Every market and every trading environment calls for different strategies. What else? Like I said, I'm also still short the corporate bonds. So, if the longs that I took on the equities today go against me tomorrow, hopefully some of that will be offset by the LQD short and other positions that I have. All right, XLY, consumer discretionary, about a 10% weighting in the S&P 500. And coming up on, let's look again. Let's just stick to the weekly charts. They're a little more clear. This one's below trend. Looks like the bull market is over. These are big sell signals. Same story across the board. Big divergences have been building for years. They do work, and they finally play out. The bigger they get, typically the bigger the correction you're going to have. And so far, this one's certainly start out with a bang, but we're back to we're to support. We're right around a little bit below the lows from 2018 there. You can see several support lines, and there's that big the highs back from 2015, 2016, and early 2017 at about 82. So the downside, to try to quantify it before a lot of these sectors hit that very, very significant, what I believe to be significant support, is limited to about 7%. So it all makes sense that if we have another flush out move tomorrow or early this week, then I think that's probably where I'll be looking to maybe add an official long trade on the site for a swing trade. Something we can go long for more than just a few hours. But we could also bounce first and then get down there on the next wave down. I'm about 50-50 right now on that, really, whether we're doing. I'm speaking to the stock market as well as XLY and everything here. They're going to move together because these are the components of the S&P 500. XLI, industrials. Well, that doesn't look good. There's the highs from 2015, 2016, and they were taken out last week but recovered, but then taken out so far. But guess what? This is a weekly candle. All that really matters is a weekly close. I'm not going to spin it any other way. Right now we're bearish because we're below there, so support once broken becomes resistance, and it's bearish until and unless we recover it. But if we can recover it again, sometime this week, you might look for a decent tradable counter trend rally. This might not be my favorite, and I can tell you it's not my favorite sector to play long for a bounce, but it's we'll probably snap back with the market if it does. XLP, consumer staples, and you can see coming up on resistance. Look at that common theme when I look at these sectors. A lot of them are just above. Well, actually, we bounced up to here about this level, but they're just above resistance or support. In this case, about 50. Now, if the 50 support, if it's hit soon and it doesn't hold, then you can see next support down there is about 47.32. And we'll just have to go from there, but that's pretty good support. There's that most of the bottom of that 2015, late 2014 to early 2016 trading range. Pretty good support. All right, next up, XLE. We're going down the line. Remember, as I go down the line, these become increasingly smaller as far as their weighting in the S&P 500. Energy, that was last I checked before this drop. It was 4.35. It's probably less than that now. I don't know if they've rebalanced, if the S&P has rebalanced the sector or not. Here's a sector in free fall, death spiral, but there you're going to see bargain hunters will come in here. So we'll watch crude. I'll probably update crude in another video soon. Crude is a commodity, so it's only going to go so low. Right now there's some unique forces. The Saudis firing out at Russia recently, saying we're going to pump. We're the lowest cost producer, so we can withstand lower oil prices better than the rest of the world. And they're right, but yeah, it's not going to last forever. And eventually, what happens on these low prices, other producers, especially those higher cost producers, they shut down. They're not going to pump. They're not going to pull oil out of the ground if it costs them more to pull it out of the ground than it does to sell it on the open market. So like everything, pendulum swings too far. You're going to see a sharp snapback in oil at some point. and then you're going to see the bargain hunters step in and buy these stocks. Those that are still still viable. You're going to see some go to the wayside, as we have in recent years. Energy's been in a bear market for quite some time. Make no mistake about it. Be careful chasing very high dividend payers, because those dividends can be cut or eliminated, and the companies can also file for bankruptcy protection. So stay away from the low price stocks. The market's usually pretty good at sniffing out which ones are going to go away, and so be careful for trading penny stock or $2-3 energy stocks that have fallen from $50, $60, $70 a share. Again, I'll do when the time is right, I'll do an update on the sector, and we'll sniff out some trade ideas, even if it's just a bear market rally. Like I said, I love trading bear market rallies. They're explosive in nature. Just like shorting in a bear market or correction, you can make a ton of money in very short order, but you got to be quick. Trading a bear market, it's like a bull market in reverse, except a lot faster. That's the only other thing. Bull market, like you're going to get bailed out when you buy stocks, even at the wrong time. Bear market, you got to be a little faster there. It's all about timing. All right, so I just want to say there's just not a lot I'm looking at here on this chart that says step in and buy. I can go back to back in the early aughts right here, 2001, 2000. See a little bit of support there. It certainly maybe comes into play, but it's not. I won't give it a high weighting because it's so far back that. Like I said, let's not even talk on XLE anymore. There's not a lot I can see right now. We'll track crude, and when I can see make a case for to step in for a long on crude oil, then maybe I'll put out some of those ETFs like XLE, XES, and XOP, or maybe even some individual stocks as trade ideas. All right, utilities. These are quote unquote a defensive sector. By nature, they are. Why? Because when the economy hits the skids, guess what? You may stop going to taking your kids to Chuck E. Cheese. You may stop going to Ruth's Chris Steakhouse, but you're not going to stop paying your electric bill. So utilities are steady Eddie companies during a recession. Their revenues are really not impacted, but they are components of the S&P 500, so they're going to come under forced selling. And it was also pretty ugly break right here. You had a price channel broke down. Where do they go from here? Well, I overshot that 56. I have 52.68 support right there. It's not a hard support level, but that is where I had the line. I'm going to add one right here because I can see there's a few reactions that have occurred. You can see below there, or this line I just put about 51 or so right there. Reactions. So we could bounce here. Again, I'm pointing out the support levels that could come into play. Other than that, if we can't reverse, we don't bounce tomorrow, if there's a little more downside, this is where I think the odds would be even better for a bounce down there about 47.24. Ultimately, where does this thing maybe go in the bear market? Probably down here at about 41.78. But again, does it go straight there without bouncing first? Probably not. Anything's possible. So let's stay flexible here. XLRE, and this is the REIT ETF. This is the one run by, this is the spiders. I'm using all the spiders ETFs. S&P has these are the S&P sectors, so I like to use these. This one's down at a pretty good support there, about 29.44. You can see a lot of support. This one hasn't traded as long as this one here, IYR. It's the Dow Jones iShares real estate ETF. And you can see it had pretty decent support there, about 71.83, but it broke support. So I have just showed you XLRE at support, but that one doesn't have as long a trading history. This one's taken out support. Either way, the longer term outlook is pretty bearish. It had this trend line here, broke and back tested, and it's been heading lower. It's not going to move the needle. I just want to say that. I don't have a strong opinion on it as far as making a trade, but as far as the weighting in the S&P 500 goes, if I can find that, it should be on here somewhere. I don't know where it went. I had it on this first board right here. It's a small weighting. It's like 2-3% at most, so it's really not going to move the needle so much. But there's a long-term chart, a daily chart, and you can see support over here as well. They're just beat down free fall right now. And then finally XLB, the basic materials. Let's see, only about a 2.66% weighting. Here's what it looks like on the weekly chart. I'm going to have to add some more support levels here. I haven't updated this one in a while. You have your 2018 reaction lows right here, but I would put that support line right about here. That's where I see it. And what I see is, yeah, we overshot that on the lows, and no, that wasn't 2018. I'm sorry, that was early 2016. But we had a reaction there, briefly overshot it, regained it there. Reactions from above, reactions from below, reactions from above, and reactions from above. So pretty much at support. And what I'd have to do, again, if I was interested in going long this ETF or any of the individual companies in there, I would pull up a list of the holdings, which are right here. I can get those holdings, and I'd have to study these charts and see, what do they look like, and are the top components coming up on support as well. These are all top holdings right here of XLB. And again, it's the same story. A lot of everything's breaking down on these weekly charts, and it looks like the start of something much worse, with more downside to come in the coming weeks to months. But nothing drops forever. So at this point, being that we're so oversold and the risk of a snapback rally is pretty high, this is where I'm starting to look for the the first swing tradable bounce, counter trend rally here. And it might be a little ways away, but I think if the market's going to continue lower, it's going to be more so in percentage points than in time. I think we're either going to bounce soon, as in probably tomorrow, or maybe the following day, or we're going to come down hard, another sharp day or two of selling, hit these next support levels, at which point valuations are going to be so darn compelling. I mean, unless this coronavirus literally just keeps the U.S. on lockdown mode for, and the rest of the world for quite some time, you're going to see an explosive short covering rally soon. So that's what I'm looking for. This one's at support there, and I'll go through these. I mean, there's hundreds that I can spend hours and hours and not even touch on this, but this is what I do. This is what I'll be doing tonight. I'm still trying to get back to everyone's questions, chart requests, opinions, but if I can sit here and spend a few hours tonight studying the charts, sniffing out which sectors are set up most bullishly for the next reversal. Again, I'm not the risk reward for shorting it right now. I'd rather let the market drop and miss out another 20% downside than to add shorts. So don't expect a lot of shorts. If I come across a unique stock or a unique sector that I missed and it looks like it hasn't, it looks like it has a lot more downside with a nice risk reward profile, sure, I'll pass that along. Otherwise, I'm going to start sniffing out what candidates or at least I'm going to look to buy for the next bounce, whether it's sector ETFs, individual commodities, or individual stocks within the most bullish looking sectors. One of those will be too. I'll get to the miners. You guys know I added gold today as a long trade, and I'll certainly be looking at the mining stocks along with it. All right, we'll wrap it up here. Get this video out to you guys. Another long one, but hopefully you can to have some nice takeaways from this, whether it's trade ideas or just considerations to make with your own positioning. Anyways, let me get it out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great evening.